with the green, I make
We'll start today with John Bever, the financial analyst over at Phase 3 Advisory Services. He said a couple of things like, look at these trillion-dollar companies. What should we know and be thinking about them? And the market seems to be poised for the correction that just doesn't seem to want to come. So, John, when's it going to come? Or maybe we've passed that inflection point already. We'll also talk about a number that Steve Alexander introduced us to earlier this week, and that is the cost of maintaining your home. And how does Illinois compare to other states? 12:11 on WGN. And again, thanks for dialing in to the Wintrust Business Lunch with John Bever today, a financial advisor at Phase 3 Advisory Services. John, welcome back to the show.
Thanks. It's good to be here. Always good to talk with you and the audience.
Yeah. Well, you were talking to Pete a little bit about trillion-dollar companies, and I don't know if you're putting something together here, like what do they all have in common, or is there a good or bad thing about trillion-dollar companies? Why are they on your radar?
Well, they're on my radar just because it's something to pay attention to. I'm not saying that they're going to drop in price. I'm not saying that they're not going to, seem like they're going to take over the world. It's just interesting. So it was yesterday that Musk suggests that the size of Tesla may, someday be 25 trillion. I don't doubt that sometime way in the future it'll be 25 trillion. The question is how soon. And the announcement was really about how he sees there being eventually more robots than human. And so it's a thing to think about because it's a disruptive industry, what's going on with AI. And we've had this before. This is not the first time. We can go back to the late 1800s and how disruptive railroads, think about how disruptive railroads were to the world. Significant. Internet in the late 1990s. Significant disruption. But what's interesting is each one of those had a huge boom in stock prices followed by quite a few bankruptcies.
Oh, really? We don't remember that as a negative thing, though, right? That's just a consequence of the evolution of industries and the economies, right?
Right, but it is very impactful at the time when those bankruptcies occur because a lot of people are invested in those companies. Right. They lose a lot of money if they're overinvested. The point is, don't allow your portfolio to get over-concentrated into these companies. It's very easy to think, they're going to the moon, and they may go to the moon, but we just don't know, so be careful to not let your portfolio get overweight.
I thought the $25 trillion was the payment package for Elon Musk. Are you sure you've got the right number there?
Yep. The payment package is one issue. This is the other issue. His is not a $1 trillion package, billions of dollars of package to him. So this is the market value of the companies. Right now we're looking in the $3 to $4 trillion mark for these absolutely largest companies. So you're talking Tesla, going up significantly, at least 10, maybe 15 times the current value of the company is how he's projecting it could happen based on how many robots they think they're going to sell. And that was just from Optimus, not anything else that he has in his mind that's cooking away. That's kind of a terrifying
thing, more robots in the world than human beings, but maybe that shouldn't frighten us, right? It's not like they're going to take over the world. It's simply that we have been able to streamline the workload for human beings by delegating it to machines, right?
Exactly, right. We're just thinking about those movies and end of the world
yeah,
type
I know. Well, do you think that the market overall, I thought you told me there was going to be a correction coming, and it hasn't come, John. What's going on here?
There's always a correction coming. Remember that every year you can expect a 10% pullback. That's just normal. That's the market breathing. Every 3 to 5 years you get a 20% pullback. So just never forget that. Don't get lulled into a false sense of security. Now, we had one about a year ago, 10% pullback, July to August. Certainly it's expected again this year, especially with it being an election year. It doesn't have to happen, but we'd be surprised if it didn't. So just be aware of that. So if you got some money to put into the market right now, maybe you just ease that in over the next 3, 4, 5 months rather than jumping in right at this point in time.
But weren't you also talking about thinking about how to reallocate your assets in your retirement plan? Like you've got a target date when you're going to retire, and therefore your portfolio sort of changes to more conservative things or into different things. Do you have any advice for us about how we're structuring those or monitoring those?
Yeah, definitely do. And part of this actually relates back to what we were just talking about, and that is the dominance of the largest companies. We're seeing an interesting thing happen in the last month where the S&P 500 cap weight, right, that's the largest companies dominate that index, that's moving up, while at the same time the S&P 500 equal weight is dropping. So what that means is that the average stock is dropping in price while the handful of these largest companies is going up. That's always something to pay attention to. And how does that relate to your target date fund? Well, most target date funds are somewhat cap weighted, which means you have a very large exposure to the largest companies. And, of course, they can all be run a little bit differently. But here's an interesting thing. The last 2.5 years, the average target date fund for someone retiring in 2035, that 2035 fund, not even up 1% per year. And so as you're getting close to retirement, you want to be aware, because if you go to take a withdrawal, not closing the account, not rolling it over. We're just talking about taking a withdrawal. When you take that withdrawal, you're going to take it pro rata across the whole portfolio. You're going to sell a piece of every fund, or if you have a target date fund, that target date fund is made up of stocks and bonds, international, domestic. You're going to be selling a little piece of each one of those. That might not be the optimal way to take money out.
Okay, finish that thought in just a minute. So then what do I do about that concern? It's 12:16 on WGN. We're talking to John Bever. We'll pick this up in a minute. Right now, Bob Kessler, why don't you pick it up? How are the markets? The Midwestern University Clinics, your family's home for healthcare. We're talking to John Bever on the Wintrust Business Lunch. John was talking a little bit about sort of rethinking how you have structured your retirement plan so that if you've got it targeted for certain ages and certain assets. John, finish that thought for me now. What was the point you were making, and then what do we do about it?
Yeah, so this really relates to how you take withdrawals. So think about this. You're right on the verge of retirement, or you're in retirement. And let's say that you've got 5 positions in that. You got like a cash position, a bond position, a U.S. stocks, international stocks, and some other kind of an alternate, real estate or natural resources. And you go to take a withdrawal. What you want to do is you want to take your withdrawal from the strongest performer at that time. That means it's grown to be larger than it should be than the rest of the portfolio based on your targeted allocation. So that withdrawal you take from the one that's grown the most. And you keep doing that. You keep rotating around those areas based on which one's done best. So if the market falls and the bonds are down, but the cash position is going to be stable, then you take the money from there. Well, you can't do that in your 401k. The reason is when you take a withdrawal from your 401k, they're going to take that withdrawal pro rata from each one of your positions. You're just going to sell across the board. And so in order to control that, you need to have that in something that you have that control over, which would be rolling into an IRA. So what do you do about this if, you're still working, but you want to work towards that? Well, you can take an in-service withdrawal and roll over that portion of it, not all of it, but a portion of it where you have some control. So sometimes what we do with our clients a couple years before retirement, we'll actually roll over a portion of that 401k into a shorter-term cash position. So when they start taking withdrawals when they retire, if the market's down, they're not locking in losses. They can go to that more conservative position in their IRA. It's just a thought, something for people to think about.
But it sounds like you're talking about maximizing the return on that investment. But what do you say about minimizing the tax on that transaction?
Yeah. So again, when you do an in-service withdrawal, you're not taking the money out of the plan, you're rolling it to an IRA, and that's a tax-free rollover. Obviously, when you need to start taking income in retirement, you're going to be paying tax on those withdrawals if you're taking it from your pre-tax account. Now, there is another way to work on saving taxes if you have company stock in the plan. And this is something that's called net unrealized appreciation. I won't go into the details right now, but the point is you can get a pretty neat tax advantage if you roll out the stock. You have to have company stock in the plan. You roll that out. Do not roll it over to your IRA, but you need to work with your financial advisor on this because the rules are tricky. In fact, I just did one with a client with a very, very large employer here in Illinois. And the plan sponsor got it wrong. And fortunately, we were on top of that. We watched it. We worked with the plan sponsor, said, this is not the way you're supposed to do this. I don't know how they did it wrong, but they did. And it could have cost the client tens of thousands of dollars in taxes. As it is, he's going to save tens of thousands of dollars in taxes by doing it, having it done the right way.
Where is your head on the Fed this week?
The Fed, I think they're slightly hawkish. And when we take a look at the data says, yeah, they've got room to do a drop here, but that Fed is waiting for that 2% inflation rate for more than a month or two. So the points are inflation is getting a little bit better, not very fast. I still have the same opinion I did the last time I was on. I think one rate cut this year. I think it's going to be after the election. I don't think they'll do a September rate cut unless we really get some positive inflation data the next couple of months. And then maybe next year too. But see, the economy is humming along. The economy is still doing quite well, handling the rates where they're at, which makes us question, where is that neutral rate? Where's that interest rate where everything is stable? My guess is down about 0.5%, maybe 0.75% from where we're at. But they cannot risk a resurgence of inflation. Interesting chart if you compare inflation from 1966 to 1980. To presently line up 2013 to 1966, the inflation pattern looks the same. Not good news for the next 10 years.
You said that's not good news for the next 10 years?
Right, because it shows that we're on the verge of another uptick maybe within the next 2 to 3 years in inflation, which would fit the pattern where you have government overspending continuing to inflate and the Fed trying to fight that. That's what we talked about last time.
Yeah, right. But then what kind of numbers are we talking there? What sort of inflation was that?
Well, hopefully nothing like the 1970s, but we might be seeing, the inflation rate might push back up into the 4% range. And again, the Fed's target is 2%, and the reason for that is the government debt. They've got to keep the interest rates low on the government debt to keep that debt service low.
Yeah, all things being equal, though, I got 30 seconds here, but if we only had one rate cut this year, what would that do to our retirement accounts? Would that be good for the equities that people are invested in? Would it be neutral? Would it be bad?
I think it'll be neutral. It certainly, won't lend the fire to push the market to even higher levels. That would be out of, too far. I think that would be the right policy at this point in time because, again, inflation hasn't reached the Fed's target yet.
That's John Bever. By the way, John, I didn't know this. You host a podcast. Did I see that as well?
Yeah, we do. It's called The Year You Retire. A lot of good ideas in there for people approaching retirement. A lot of the things that we've just talked about, we go into more detail, so it's a lot of fun.